Today, folks, we're diving down into those monstrous REITs, the real estate investment trust world of Canada, at which I believe REITs are trading mostly at discounted values. They're trading below their net asset values. You go assets minus liabilities. We're seeing a lot of discounts up there because of the fear in the real estate market, thanks to the interest raising environment. But then we have inflationary pressures on the rental market. So if rental prices are going up, these REITs should get some cushioning and we should see some growth from the rental income. But we're going to talk about all of that and more because we recently saw earnings coming out of CAP.REIT, Canadian Apartment Properties. We're going to break down. We're going to take a look at Slate Grocery REIT. This is a US REIT that does trade in Canada here, but it's focused on grocery encore tenants from your Walmarts, your Krogers, very recession-proof, stabilized kind of a business, but is it from a balance sheet standpoint? And then finally, Dream Industrial. You know, these industrial sectors have been blowing up lately because Dream is going to be acquiring a piece of Summit Industrial. There's a lot going on in this video, and if it's something you appreciate, if you're a fan of dividends, distributions, that monthly income, hit that like button, folks. Again, not financial advice. These are just my opinions, but kicking it off with Canadian Apartment Properties. Firstly, when it comes to a REIT like this, we're not talking high yield, but we're also talking growth. So you kind of get the best of both worlds, and I always recommend buying these REITs when they dip because you don't get a lot of dividend growth, but this one gives you a little bit. We'll take a look at in a second. But ideally, every time it dips down to below like this $40-$45 range, it's a really good buying opportunity where you'll cap in over a 3% yield, and you're probably going to get some good growth moving forward because I don't think this REIT is fairly valued at $8.3 billion. You know, their net asset value I think is closer to $9 to $10 billion. So you're definitely getting a deal as it stands today, depending on what the real estate market does. Because again, take a look at the dividends. 10 years ago, you were getting about 9 cents monthly. Today, you're getting about 12 cents. And it's like a 30 or 40% increase. It's not the best compared to like Canadian banks or some other Canadian stocks, but certainly not the worst considering, again, it's kind of a nice balanced rate of return, right? But getting into this, take a look at this. If you've never heard of CAP.REIT before, guys, this is a conglomerate when it comes to Canadian rentals. Like, I mean, they own 59,686 total suites. I don't even know how you wrap your head around that. With another 6,900 in the Netherlands, they're almost 99% occupied, and their net average monthly rent is at $1,386, which should only go up because I don't know anyone paying $1,300 a month for rent unless they're living in a basement, because the average rent everywhere is like, you know, Ontario is like $2,500 to $3,000, and everywhere else is like at least $1,000 to $2,000. But nonetheless, we can break this down by their different locations. British Columbia is 10%, Alberta's 4% of their entire property, Saskatchewan 1%. There's Ontario with 40%. If 40% should start seeing some hikes here soon, considering their net average monthly rent is $1,506, which seems laughable to me. I don't know where in Ontario you're renting for $1,500 a month, so we should see continual uptrends in their total rental income when you divide it between all their properties over time as tenants swap out. But let's take a deeper look into here with the numbers themselves, because we can see it's kind of funny. For total of 2022, we can see that they netted about $1,200 in monthly rental income, but that's up from the $1,149, which isn't, it's only up by like $50 from 2021. That's kind of concerning. We should see that go higher. And again, they mentioned that the average total rental income here, if we take a look, guys, has been going up to $1,386. So that will reflect on the year end for 2023, because obviously that went up really dramatically through 2022. But taking a look at the numbers, the dead ones and zeros here, guys, total debt to book values at 40%, very, very healthy. You got total weighted mortgage interest rate, which is the fascinating thing, went from 2.47% to 2.61 with the average term of 5.4 years. So we have time for the interest raising environment to cushion out, but the fact is it's very unlikely we're going back to 0% interest rates. Like, they were so low that I don't think we're going to go back there. So over time, this is going to go higher, but I'm confident that it's going to get cushioned by this rapid increase of the cost of rent for their tenants, right? So we should see some cushioning to the raising interest rated environment. So there's a lot going on here, but all in all, this is pretty good. Like I said, the only thing I really want to pay attention to is the funds from operation going up? Yes, we're seeing an increase here, guys. Are the total rents going up? Yes. This is a good, really diversified REIT. The only risk with REITs, in my opinion, is management. If management is dumb at this scale, that's your biggest risk, because you're basically buying an ETF. You buy one REIT, you're buying an ETF on an entire portfolio of real estate. If they had to liquidate it all tomorrow, you know, so long as they have more assets than they have debt, you're going to get some money back. These are very safe investments, the right ones anyways. Now let's talk about Slate Grocery REIT. This has really captured my attention over the last year for two particular reasons. First and foremost, the yield, dividend distribution at almost damn near 8 freaking 8%. That's like market average return just from a dividend, but we're not getting two things from that. We're not getting any real stock appreciation, and we're not really getting any dividend growth. So if you're looking for cash flow today, that's all you're really going to get from this REIT. But the second thing that captures my attention is that over the last year, it has been much more stable than the likes of even the S&P 500. Now, keep in mind, yeah, it did drop about 24 to 25%, but it has been pretty much flat for the last year, which the S&P 500 is still down. And you take a look at the long history here with the most volatility experienced during the pandemic, where it rallied back 130% from a 50% drop. Whew, man, what a buying opportunity. I can't imagine the yield it would have been paying down there. Now, keep in mind, this is a smaller capped REIT, but let's kind of get into the ones and zeros, the numbers. It sits on 117 properties across 24 states with over 15 million square feet. So very diversified, but highly fixated on, obviously, encore tenants and grocery stores. So we can see 35% of their entire income comes from supermarkets and grocery stores like Kroger's, like Walmart, like Publix, et cetera, et cetera. They got some medical and personal services, financial institutions, dollar stores, liquor store. Very stabilized tenants. This is what I love to see. It kind of falls in line with RioCan almost here in Canada, these mall or these kind of retail focused REITs, but this one specifically is very niche focused, and I kind of like that because this seems to be a recession proof kind of industry. Taking a look at the rental revenue, one thing I always love to see is it going up over time from 138 million to 177 million, with net income going from 87 million to 138 million. It looks like they're doing something correct here. I don't know how they're getting this income to go up so dramatically, but they're doing a wonderful job. So let's talk about the dividend. Is it safe? Well, currently the funds from operation payout is 78.8% and has been trickling down over time, with the adjusted funds from operation payout at 96%. But this is at the higher end, and typically this is what we want to see from REITs, because most REITs do pay out the vast majority of their earned income. But taking a look at the average debt here, guys, firstly, they're about 50-50 leverage to assets. So they have, half their assets paid for, half is leverage, which is typical for a REIT, nothing too unusual there. And the interest rate is kind of intriguing at 4%. This average weighted interest rate is much higher than the likes of Canadian apartment properties. But this is a good and a bad thing. There's two things to this. Firstly, Canadian apartment properties, I think over time we're going to see the interest rate naturally go up, because interest rates will never go back to zero for the foreseeable future. So because this is already paying such a high interest of 4.29%, I don't think it can go up that dramatically higher, whereas someone paying a much lower interest rate will see that trickle up on a percentage basis much higher than someone that's already at the upper bounds of what the interest rates are. So that's something intriguing to just take into consideration. But all in all, this is a pretty healthy balance sheet, and the earnings aren't that bad. So I do like Slate Grocery. I'm not buying it. I'm still continuing to watch it. But if you're looking for dividends, hey, I would take a second look at it. So coming into Dream Industrial, the industrial sector has been where all the growth has been. I mean, we can see basically, especially coming through the pandemic, this thing was exploding. And as of recent, Dream Industrial has rallied up 40-50+%, paying a 4.7% dividend yield. A lot of this has been driven primarily from this acquisition. They partnered with another company, which I think is clearly a Singapore company here. I think it's called GIC, and Dream are basically acquiring Summit Industrial for $23.50 per share. And Summit was one of the largest industrial REITs in Canada. I mean, you can see it was about a $4 billion REIT here, and it just got purchased out, so this thing is probably going away. I don't think it's going to be publicly traded anymore. I'll have to double check that. But taking a look, guys, I don't know why Dream is exploding on this news, because respectively they're only owning 10%, whereas GIC is taking 90% control. So it should add to some bottom line for them, but I don't know if that's enough to shoot the stock up as much as we've seen it since the announcement, which was, I think, toward the end of last year, beginning of this year. But Dream Industrial, I really like the industrial sector, whether it's Granite Real Estate, we got Dream Summit. They're really good to have as part of your portfolio for more growth oriented, and dividends, clearly. I mean, Dream's paying 4.73%, but I'll pass the question off to you guys. What are your favorite REITs here in Canada?